Well, thank you very much, everyone, for joining. I see we've got our participants coming in online. We're just 1 minute after 12. We'll maybe give another 30 seconds for attendees to join as I see the number climbing before we get rolling with our intro.
Show the slides.
Well, thank you very much for joining. My name is Jeff Colleen. I'm the Policy and Program Director for the PDAC, PDAC as many of you call us. And I want to thank everyone for taking the time to join us here today. It's June 11th. It's a warm, windy day in Toronto, and we're here to talk about flow-through shares. As you know, the PDAC, we are a member-based organization. We do a lot of work on behalf of our members outside of the convention. And a lot of the time you hear the organization talking about flow-through shares, it's because they are so instrumental, because they are so important in attracting capital to mineral exploration in Canada. There are a lot of nuances within the flow-through share regime. We have some great partners here today on the panel to be able to discuss some of the nuances within the flow-through share regime and help hopefully issuers, retail investors, institutions, and anybody who's working in and around the flow-through share regime have a better understanding of some of those nuances, how they connect at the federal level and within the provincial level. So thank you very much to our three panelists who are joining us today. First, you see the picture on the right is Lisa Davis. She's the CEO of Pear Tree Securities. Lisa's been the CEO for quite some time. She oversees all of the strategic direction of the firm. She has an extensive experience in business and in law. She's a former PDAC board member. She's a former co-chair of our Finance and Taxation Committee, still a committee member, and very thankfully been a great contributor to PDAC over the number of years. Michael Long, a tax partner with KPMG, very well versed in mining taxation, has been working with many issuers in Canada for many, many years. He has over 20 years of experience exclusively providing tax services to Canadian and multinational companies engaged in the metals and mining industry. He's also a co-chair of our Finance and Taxation Committee. And last but not least is tax senior manager Stephanie Holland, also with KPMG. Stephanie has been a senior manager with over 15 years experience, focused primarily on providing income tax services to multinational and Canadian companies, as well as royalty companies, and again, focusing on that mining sector. So thank you to all three of our panelists for joining us today and being able to bring that brain trust. Next slide, please. Just very quickly, a disclaimer: all of the information we're sharing is is valid as of about a week ago, and appreciate if you take the time to read those words. This slide deck will be available afterward as a reminder. So to get us launched off, last bit from me, we're showing a Lassonde curve, this stylized Lassonde curve that many people have seen in many different iterations over time. Why are we starting with this? Well, flow-through shares are an instrumental part of why this curve looks the way it does. The incentives around the flow-through share regime that make cost of capital more appealing to an issuer, that make it more attractive to an investor, that's a part of what fuels that first stage exploration. It's a part of what really causes that ramp up, hopefully, in valuation in the marketplace as exploration is ongoing and as new discoveries are being made. So it's institutionalized to a point where it's become 60, 70% of the exploration work done in Canada is funded through a flow-through share. So it is a key part of everything that we do here in terms of mineral resource discovery in Canada. Very briefly, we do know this, as it's colloquially called, the Valley of Death, where we show valuations dropping off as companies get past that initial discovery stage. They start working through scoping and assessment work. Just as one passing comment for our members, that's part of what PDAC is advocating to our federal government right now, is to expand some of the eligibility within flow-through, to allow some of that scoping and technical work, to try and fill in, if you want to think of it that way, some of this Valley of Death, trying to protect against some of that valuation downturn and being able to give companies a bit more flexibility in their balance sheet to be able to spend flow-through shares and keep projects moving forward. But that's it from me. Now over to the smarter folks on our panel to dive into flow-through shares. And thank you very much again to Michael, Stephanie, and Lisa for joining us today.
Thank you, Jeff. As Jeff just mentioned, it can be very challenging for a non-revenue producing junior exploration company to raise capital. There's very few options, generally just raising equity. And so some time ago, it's been actually goes right back to the 1950s. Originally, the federal government introduced the flow-through share regime. This is something that's been very effective to allow companies to raise capital when they have limited options, and we're looking at a situation in which we've got very high risk speculative investment, and attracting equity capital is not easy. So since these companies are not generating income and may not generate income for many years, when they do have capital to spend on exploration activities, they have no revenue against which they can deduct tax deductible expenses. What the flow-through share regime essentially does is it allows issuers to transfer those exploration expenses that would otherwise be a deductible expense of the company to the subscriber for flow-through shares. And in the language of the Income Tax Act, those expenses are renounced to the subscriber, which means that the subscriber can then deduct those expenses against his or her taxable income. It's been as I've already mentioned, it's been a very effective program. And I would suggest, and I think I'm not the only one who would, that relative to a lot of other government programs, it's a very efficient means to get capital to these junior projects, unlike some of the other things that have been introduced or in the process of being created, such as the Sovereign Wealth Fund that I guess was announced just a few months back. This is a way in which we can let capital markets work efficiently as they should, without any direct government intervention and without having to establish a new agency and figure out governance and staffing. And then, of course, the choice of which projects benefit can take a long time and can be fraught with a lot of conflicts. We're just trying to move to the next slide. Be able to, thank you. So the slide that you see in front of me is just a depiction of how the mechanism actually works. You see there's the mining company issues shares, which are essentially just flow-through shares for cash consideration. The mining company then uses the proceeds of the sale of those shares to invest in a Canadian mineral property. Those expenditures, and you'll hear more about this shortly, have to be qualified as Canadian exploration expenses, or in some cases, Canadian development expenses. And those qualifying expenditures are then renounced to the investors who, as I mentioned previously, can deduct the amount of the subscription price used on qualifying expenditures against their own taxable income. The original flow-through share program, which dates back many decades, was simply something that allowed the deductibility of up to 100% of the subscription proceeds for amounts spent properly. We saw some changes over the years. In 2000, the mineral exploration tax credit was introduced, and that's a federal 15% tax credit against taxes payable, as opposed to a deduction for early stage exploration, essentially exploration from the surface of the earth. And then in 2022, we saw the introduction of the critical mineral exploration tax credit, which really bolstered money being funneled into exploration for critical minerals, which of course is a priority for the Canadian government and others right now. One thing I would mention is that while the investment has to be used to fund exploration of a Canadian property, the issuer itself does not need to be a Canadian company. So we've actually seen, particularly for companies that are based in Australia, that are doing work in Canada, a lot of flow-through share offerings over the past number of years by those companies. Takes a little bit of structuring, but it's something that's become relatively regular. There he is. Too quick on the trigger here. Okay, so this is just a chart showing the amount of flow-through share dollars that have been raised over the past decade by flow-through share offerings on Canadian exchanges. One of the interesting things that's happened over time is that of the amount that you see here being raised, I would estimate that about 80% is done as what has come to be known as charity flow-through offerings, and I'll get into that a little bit more in a moment. Originally, when you go back prior to the last decade or even a little bit earlier than that, most of the money that was available for flow-through share offerings came from the so-called traditional flow-through share funds. And those were funds that raised pools of capital from Canadian retail investors for the most part. Over time, as the charity flow-through program has become much more popular, and for reasons I'll discuss in a moment, has some additional benefits for issuers and investors. That traditional fund money has shrunk considerably and probably makes up about 15% of the funds that go into flow-through share offerings. The other thing that's interesting, it's not shown on the slide, but the proportion of money that is going into precious metals versus critical minerals over the past few years has changed quite dramatically. In 2022, when the critical minerals exploration tax credit was introduced, we saw a big change. Obviously, there were other factors involved in that, but I think that there really was, some evidence that a tax credit like that, which is 30% as opposed to 15% for non-eligible critical minerals, can really make things happen quickly. Oops. Okay, there we go. This slide is really looking at things more through the lens of the investor. So from the perspective of an Ontario resident individual investor who is looking at putting money into a flow-through offering where the proceeds would be used to target critical mineral exploration in the province of Ontario, if that investor put $1,000 into the offering, what you see here is the two red bars illustrate the value of the deduction at the combined federal provincial top marginal rate for the subscriber. So that reduces the after-tax costs considerably at that marginal tax rate of about 53%. Then the next two orange bars are showing the value of the federal critical minerals exploration tax credit, which, as I mentioned, is 30%. It's somewhat reduced under the federal rules because there is also an Ontario tax credit of 5%. So that's that $50 in the second orange bar. From there, you actually get a bit of a increase in the cost because the credits that are received in the year of subscription are treated as income for that subscriber in the subsequent year. So that reduces the whole basket of tax benefits somewhat. But at the end of the day, what you'll see is it's a $310 after-tax cost for a $1,000 investment in a flow-through offering of this nature. One thing that is not shown on this, which is important to note, is that the cost base of flow-through shares is deemed to be zero. So when the shares are sold, the capital gain is the full amount of the proceeds of sale rather than just the difference between what was paid or the after or the adjusted cost base for tax purposes and the proceeds of sale when the shares are finally disposed of. So that, depending on the circumstances, can obviously make a difference. So I did mention that the charity flow-through share program has become sort of the dominant force in flow-through share offerings. This slide shows the mechanism, which is pretty straightforward from an issuer's point of view or subscriber's point of view. There are certain things that are done in the back office of the charity provider, but essentially, as you see in this slide, and this would be a situation of a critical mineral exploration project. If you've got shares trading, for example, at $1, the issuer would be able to issue the flow-through shares at a pretty robust premium, in this illustration, $1.30. The donor then donates those shares to charity, and only the initial subscriber for flow-through shares is entitled to the tax benefits. So as soon as those shares move out of the hands of the initial subscriber or donor, they become just common shares. So they've been stripped of their tax value. When the donor donates the shares to charity, the charity then issues a donation tax receipt, and that charity will then immediately sell the shares on to what we refer to as an end buyer, generally at a discount to market, in this case, 85 cents. And the charity will be able to issue the tax receipt to the donor at what we recommend is at the cost or at the price that's actually paid by the end buyer, so 85 cents. That difference between the issue price and the sale price is referred to as the delta. And the delta can vary depending on market conditions and also depending on the total value of the tax benefits. So whether it's a precious metal exploration play or critical minerals, and then different provinces have their own tax credits that are at different rates. So that delta varies from time to time. For the issuer, there are tremendous benefits. Generally speaking, there's quite limited dilution relative to other equity offerings that could be done. And one of the biggest benefits is that traditionally flow-through share offerings would only be done to an audience of Canadian, primarily retail investors, because those tax benefits are only available if you're a Canadian taxpayer. By separating the tax benefit package for the initial subscriber from the shares that are ultimately sold to the end buyer, you've opened up that universe of investors to a global market of institutional strategic investors, and that's very desirable for issuers. Finally, I just want to take a minute to mention who are actually the buyers of flow-through shares. Based on the most recent data available from StatsCan in 2024, what we've seen by looking at the deductions for exploration and development expenses by taxpayers is that over 90% of all flow-through funding is actually provided by only about 12,000 taxpayers who are in the highest marginal tax bracket. The numbers don't jive completely if you went back to the chart of how much flow-through was raised in 2024, which was probably, think about $1 billion as opposed to 800 million. But when you look at the data that comes from StatsCan, it's talking about who deducted exploration and development expenses in that year, and people have the ability to, in certain circumstances, to carry those deductions back or carry them forward. But this does, I think, give you a pretty good picture of where the money is coming from. And of that amount, as I said earlier, the charity flow-through offerings account for probably about 80% or more of all flow-through shares. And one thing that I think is, it's fairly technical, and it's not something that I think a lot of people are aware of, is that there is something called alternative minimum tax, which is a parallel tax calculation that applies to high income earners who otherwise would pay little or no tax as a result of various deductions and credits. Taxpayers are required to pay the higher of either their regular tax or alternative minimum tax. There have been a number of changes recently introduced to alternative minimum tax, which has really a disproportionate impact on flow-through share subscriptions, partly because, as I mentioned earlier, the cost base of flow-through shares is zero, and there's an add back of the capital gain that's higher than under the regular calculation. There's also an add back of the Canadian exploration expense deduction. So anyone has the opportunity to talk to anyone in government, I think raising the fact that there's this perhaps unintended consequence as a result of alternative minimum tax is something that's actually impacting the industry quite negatively. And I will pass it along to Stephanie.
Thanks, Lisa. And thank you, PDAC, for the opportunity to be here today. So Lisa has touched upon some of the investor-related considerations of flow-through share offerings. And now we'll turn our attention to the mining company or issuer-related considerations. So the first question is, who can issue flow-through shares? And it's principal business corporations or PBCs. So what is a PBC? A PBC is a corporation whose principal business is mining or exploring for minerals. And so many mining companies are structured so that a public company is the parent and the subsidiary holds the mining properties. So there's an ability for the parent itself to be considered a principal business corporation if all or substantially all of the assets of the parent are shares or indebtedness of a related corporation that is itself a PBC. And as Lisa mentioned, a PBC can be a Canadian corporation or a foreign corporation. So in the course of a PBC undertaking a flow-through share issuance, it agrees to incur what we refer to as qualifying expenses. So qualifying expenses are certain types of Canadian exploration expenses that are generally described as grassroots exploration activities. We also refer to them in tax law as paragraph F, and you may see them referred to that in the slide deck, as well as certain types of Canadian development expenses that are mine development expenses, either pre-production or post-production mine development. So it's important for a PBC to incur qualifying CEE or CDE because there are financial consequences for a failure to meet obligations. And from a subscriber perspective, the CEE provides a 100% deduction, and it can attract the critical minerals exploration tax credit and the mineral exploration tax credit, which Lisa touched on as well. Compared to the CDE, which only offers a 30% deduction. So there is clearly going to be a subscriber preference for CEE, and that can lead to larger premiums. The slide is not working. Thank you. So with respect to qualifying CEE, these expenses need to be incurred for the purpose of determining the existence, location, extent, or inherent natural qualities of a mineral resource in Canada. And so the CEE definition includes various types of spending that's shown on the slide, such as prospecting and drilling, and it specifically excludes Canadian development expenses, because those are dealt with separately, the capital cost of depreciable property like plant and equipment, and expenses related to a mine that has come into commercial production. One thing that I want to highlight in this definition is that CEE is for spending related to a mineral resource, which is a defined term that I'll show on the next slide, and the spending has to take place in Canada. So the next slide here shows the definition of mineral resource. And for a company to be eligible, for a flow-through share issuance to be eligible for a CMETC or METC, you have to incur qualifying CEE for a mineral resource. And that's generally going to be an A or D of the definition shown on this slide. And I've bolded DI. If you're in that category, you need to consider whether NRCan would certify that the principal mineral extracted is an industrial mineral contained in a non-bedded deposit. So a couple of pragmatic points on this is that the certification process can take several months. And there is a process outlined on NRCan's website. Prior to submitting, you can contact NRCan to see if your specific fact pattern would fit the definition. And note that not every critical mineral project is automatically going to be considered CEE or automatically considered a mineral resource. So CEE classification for your flow-through share offering would not be a guarantee. The next slide. So on an earlier slide, I had outlined what is considered a qualifying CEE, and I had shared the definitions that it's expenses incurred for the purpose of determining the existence, location, extent, or natural inherent qualities of a mineral resource in Canada. That's a recent proposed amendment, and previously it was just the term quality. And why that matters is that historically, CRA has taken a very narrow approach to the interpretation of the term quality. It was really limited to the mineral resource's inherent physical, chemical, or mechanical characteristics. And CRA had generally taken the approach that pre-feasibility and feasibility work and other economic viability work would not be qualified as CEE unless they directly related to those inherent qualities. There was a recent court case at the BC Supreme Court where the outcome was positive for potentially broadening the interpretation of what could be considered CEE. And it said that the purpose test includes economic viability. And in that case, the court allowed the taxpayer to claim refundable BC exploration tax credits for expenses that directly contributed to the economic viability of a potential mine. And so fast forward then to budget 2025, after the BC Supreme Court case, Finance released draft amendments to clarify that the expenses incurred for the purpose of determining the quality of a mineral resource do not include expenses related to determining the economic viability or engineering feasibility of a mineral resource. And the explanatory notes say that the amendment is intended to confine CEE to the resource's underlying inherent physical characteristics and to exclude economic viability work, which largely aligns with the CRA's historic views. And this is in contrast to the Canada Strong 2025 platform that said it would expand to include the costs of technical studies for critical minerals. So this slide shows the different buckets of how you can think of CEE offerings. So first, you have a regular CEE offering where you would have a 100% deduction of the subscription amount when a CEE is renounced. Then you could have a CEE offering that also has the METC or mineral exploration tax credit attached, which is an additional 15% federal tax credit. And then you could have a regular flow-through share offering for CEE with an additional 30% federal tax credit. So it's important to note that CMETC and METC are available to individual shareholders, not corporate shareholders. And to be eligible for the METC or the CMETC, the expenditures have to be flow-through mining expenditures or flow-through critical minerals mining expenditures, which needs to fit a specific definition. So a flow-through mining expenditure is generally described as CEE mineral exploration activities conducted from or above the surface of the earth. And the definition excludes certain forms of trenching, digging test pits, and preliminary sampling. For CMETC, flow-through critical minerals mining expenditures, the definition is similar, but one important thing to note is that a qualified person needs to certify that the expenditures being renounced will be incurred as part of an exploration project that targets one of a list of specific eligible critical minerals. And if the qualified person can't reasonably demonstrate that the minerals targeted are primarily eligible materials, then the related spending would not be eligible for CMETC. And you cannot then fall back on METC at that point. So it's just important to be aware that not all flow-through shares are going to qualify for the METC and the CMETC. And then one last point on this slide is just that for the various provincial tax credits that are offered, although each province is different, the key is that the exploration activity is undertaken in the province and renounced to an individual resident in that province. So, for example, exploration undertaken in Ontario and renounced to an individual who's resident in Ontario. Next slide here is outlining the NRCan's list of Canada's 34 critical minerals. And the key point that I wanted to make here is that the list for the CMETC is a subset of this list. And Quebec has a separate list. It contains many of these and maybe a few others. So it's important to check the relevant legislation and don't just assume that if a critical mineral is on this list, that it's going to qualify. And in some contexts, like a flow-through share CMETC offering, you may need to get NRCan certification so that it can qualify as a mineral resource. And on this slide, we've talked quite a bit about the CEE because, as I mentioned, that it drives the 100% deduction, which is attractive to investors. But you can also renounce CDE, which drives a 30% deduction to investors. And this slide outlines that the types of costs that can be included in this category includes pre-production and post-production mine development expenses. And so when we talk about pre-production, those expenses are incurred for the purpose of bringing a new mine in Canada into production in reasonable commercial quantities and are incurred before the new mine reaches a commercial level of production. And the key again is meeting a purpose test. And then in the context of post-production expenses, mine development costs incurred after the mine has reached a commercial level of production, the tax law includes the costs that are listed on the slide. And again, I just wanted to point out that similar to CEE, it does exclude the capital cost of depreciable property and costs of Canadian resource property, which, although they are considered CDE, are not eligible for flow through. And when I say Canadian resource property, I mean costs incurred for mining rights and maybe royalty interests on mining properties in Canada. So now I'll pass it over to Michael.
Thanks, Steph. As we move forward here, I think we've given you a background as to what the flow through share program is, what the type of expenditures are meant to capture. In this section, we're going to talk about interpretive issues, non-qualifying expenses, as well as some practical tips. The key takeaway, perhaps, for everyone to recognize is that not every expenditure incurred in the course of an exploration program will qualify for CE treatment. I think that's important to note because although the program is meant to be very inclusive, and it's an inclusive definition in the paragraph F CE definition, and as a purpose test, there are some limits as to what you can renounce and what you can incur. And we're going to go through some of that, as well as some of the guidance that exists from the Canada Revenue Agency in order to really support and assist issuers in ensuring that they are incurring qualifying expenses. So first off, we're going to talk about non-qualifying expenses. What specifically does not qualify and is excluded under the tax law. This largely includes administrative costs, G&A, financing costs. So if you incur legal fees, banker fees in the course of issuing flow-through shares, those expenditures do not qualify as being CEA. In addition, salaries and wages can be problematic in that the tax law requires that the individuals be spending substantially all their time dedicated toward exploration and development activities. The CRA has a general guideline of 90% or more, although some case law has suggested it could be lower. But the key is that those individuals need to be substantially dedicated towards exploration development for their salary cost to qualify. The same tests, apply to maintenance or rental property. So, office lease costs, same consideration as well. Just moving on to other buckets of common ineligible expenses would be the cost of the mineral property itself. So the cost of obtaining right, to explore, acquisition costs from a third party of their existing rights. Those would not obviously be eligible. They're specifically excluded, as are the costs of depreciable property belonging to, prescribed class. So if you think about fixed assets that are acquired, those would not be eligible for CEE. The CRA actually, in the course of reviewing issuers' flow-through share claims, will review your list of expenditures, and to the extent that they see depreciable property costs, could even be things like core boxes or tents, they will likely deny them as CEE treatment. Luckily, the Canada Revenue Agency has published what they refer to as their mining expenditure review table. This actually, was a very useful document that issuers and advisors alike use really to assess whether or not planned exploration activities could fit within the required confines of CE under its paragraph F definition. This document actually is 10 pages long. You can find it on the PDAC website, and it goes through 33 types of expenditures and considers what they would be classified as for, whether or not they'd be paragraph F CE and capable of being renounced, or alternatively, some other treatment being cost of depreciable property, operating expense, or a Canadian development expense. The key here is that this represents really a consolidation of the Canada Revenue Agency's views on CE and mining exploration. It doesn't have the force of law, but practically speaking, issuers and advisors rely on this as really providing them a guidelines as to what the CRA would accept in the course of reviewing a flow-through share issuance. So in terms of issues and pitfalls, we just wanted to highlight that there is a requirement to incur not only qualifying expenditures but within required timelines. And so when an issuer raises funds from flow-through share investors, depending on the nature of that issuance, whether or not it's and we'll get to this later, a look-back pronunciation, there are specific timelines that must be adhered to, and the expenditures must be incurred with those timelines. When you think about your overall bucket of expenditures that you incur, issuers need to be aware that government assistance, as well as any proceeds from the exploration activities, reduce the amount that can be renounced. So if there's sampling undertaken as part of your exploration activities, the revenues you derive from that will actually reduce your total expenditures. It's just something to be aware of as well. Often, the issuer is a public company. It raises funds from the subscribers, but the subsidiary owns the exploration property and will undertake the exploration activity. In such instances, often it's required to what we refer to as a back-to-back arrangement, where the parent will actually subscribe to flow-through shares of the subsidiary so that the subsidiary can incur the expenditures, renounce them to the parent, and then the parent can fulfill its flow-through share obligations. This is often an area that can be missed, so it's important if you are looking to raise flow-through share funds to understand which entity in the group will actually be undertaking the activities and whether there is a mechanism in place to ensure that the qualifying expenditures can actually pass through to the ultimate flow-through share investor. So what happens if the corporation fails to meet its obligations? First off, under the existing Part 12.6 tax regime, there is a penalty tax on the unspent obligation. And as in the case of many issuances, there is an indemnity obligation to the investors. This can be quite expensive, and it must be funded with hard dollars. So obviously, it's very punitive. In addition, the issuer would have to amend all of its slips. The investors would have to amend their personal tax returns, creating a large compliance and administrative burden. And finally, and perhaps most importantly, it will potentially damage the reputation of the issuer amongst its investor base, and obviously could impact its ability to raise funds in the future. So, the key being here that there are requirements that you must abide by within the flow-through share regime. There's a lot of CRA guidance out there. It's very important that ensure that you've incurred sufficient qualifying expenses within required timelines to avoid some adverse consequences. And just finally, just wanted to highlight that the flow-through share regime is an income tax incentive, but many of the provincial mining tax regimes actually reduce your provincial mining tax deduction to the extent you've renounced the exploration or development for investors, just something to be aware of. Now, perhaps just shifting a little bit to things that are more interpretive in nature. We've talked about that, in order to have paragraph FCE, it must be incurred on a mineral resource prior to a mine coming into commercial production in such resource. And there's often a question of, well, when does that mine reach a commercial level of production? And in particular, you'll see a lot of instances of brownfields exploration, where perhaps there was a past producing mine that has now, been recently reacquired by a new junior, and that junior is looking to explore that property and see whether or not it can bring a mine into production in such resource. There is a large body of case law as to what a new mine is versus what an extension of or a continuation of an existing mine is. One thing just to be cognizant of is that the courts do look at, well, does the existing workings of the mine, could they actually be used? Or are we looking at an instance where we'd have to implement brand new workings? Similarly, it's possible that there may have been mining activity on that property in the past, but it never reached a commercial level of production. The key is there's no bright line test. It's very fact specific, and each issuer should ensure that the mineral resource that it's exploring on actually is capable of having paragraph FC occurred on it. Furthermore, as we go back to the underlying purpose test, the CRA guidance and the recent 2025 budget changes that happened last fall, the key really is to tie back the expenditure to the purpose test. Why did you incur it? At what stage of the mineral exploration life cycle are you incurring, and what was the purpose of the expense? As Stephanie highlighted earlier, the federal government has sort of narrowed the confines of what the word quality means, changing the word quality to inherent natural qualities. And costs that relate to feasibility studies, economic scoping studies, engineering work, are potentially highly contentious and do pose some risk, and therefore issuers really should think about what they're spending their money on, whether or not it could meet at least the narrow confines of paragraph FCE. I've also listed here environmental studies and community consultation. The key here is at what phase of the life cycle are they being incurred? Are you incurring environmental studies in order to meet the requirements of an exploration permit or to obtain the right to explore? Or are you doing environmental studies to see whether or not you will bring a mine into production? Again, it's tying it back to the purpose test, the exploration phase, and ensuring you're not going beyond the confines of the existing tax law. Finally, just as relates to underground exploration, this is often an area of contentious as well, because the question is this underground exploration being incurred for the purposes of bringing a mine into production, which could be CDE, or is it for the purpose of further defining an existing resource? Again, there's no bright line test. Whether or not an expense is incurred for the purposes of bringing a new mine to production or for the purposes of determining the existence, location, extent, or inherent natural qualities of the resource is important. And as I mentioned before, the key is to document, understand what your budget what your budget is spending your dollars on, and ensuring that you at least tie it back to one of the qualifying purposes. On this slide, we've highlighted some of the timing that's relevant, particularly to a look back renunciation. And so most issuances of flow-through shares these days are look back renunciations, whereby in year one, in this example we have in October of 2026, the issuer issues flow-through shares to investors and agrees to renounce or pass through the tax deductions to investors as of 12/31 of 26. In these scenarios, the investor will get their tax deduction in 2026, and the mining company has until the end of 2027, 12 months from the date of renunciation, the effective date of renunciation, to incur qualifying expenditures. The key here is that the expenditures must be incurred with this time period, cannot go beyond the 12-month period. And if you do, there will be the consequences of the Part 12.6 penalty, and obviously other issues as it relates to amending deductions. The CRA actually has very helpful publication on their website. I think they call it Instructions for the Flow Through Share Program. It's T100, that has a similar chart as well as all the guidance that an issuer may need to understand its compliance obligations, to ensuring that it not only complies with the timing requirements, but also the documentation requirements in terms of issuing forms to investors showing them the amount of renunciation, as well as filing forms with the CRA so that they can, properly document their flow through share issuance. We've talked a lot on flow through shares. Above and beyond flow through shares, there are a number of incentives that probably could warrant their own session, but we figured we just briefly, talk about a couple here today. So in terms of, if mining companies want to use their own dollars to fund exploration, say they just do a private placement that's not a flow through share issuance, there are a couple provinces, namely British Columbia and Quebec, that offer corporate level credits where the mining company itself can actually attain a refundable tax credit for their exploration activities. You can see BC's up to 30%, depending on the location of the province, and Quebec, particularly for critical and strategic minerals, could be up to 45%. Quebec recently expanded their credit to include not only exploration expenditures, but also certain mine development expenditures, but did implement an expenditure cap of 100 million of spend over a 5-year period. So those are two provinces in particular where funding is through hard dollars, corporation itself can get a incentive. And again, these expenditures must be in province exploration with the incentive given by the province. Going beyond the exploration phase and thinking more about perhaps advancing a mine towards production and building a mine, the federal government does have a couple referred to as clean economy ITCs, investment tax credits, that are designed to encourage and support investment in depreciable property. Relevant to a critical minerals mine would be the CTM ITC, which is 30% refundable credit for the acquisition of depreciable property used in either the extraction or processing of what we refer to as a qualifying critical mineral. As Stephanie talked about earlier, sadly, there are different lists of critical minerals for every incentive. This one is more narrow than what otherwise would qualify for the CMETC for flow-through shares, so something to be just aware of. And then in addition, there is the Clean Technology Investment Tax Credit, which could be useful, for example, if you're making investments in non-road zero-emission vehicles. So you see there's obviously a number of credits that exist out there. It's important for a mining exploration company, either in the exploration phase or looking to advance their project to production, to understand, the different incentives that may be available to them. There's more than just flow through shares, particularly as you advance towards mine development. Excellent. Well, we've covered a lot of material. Perhaps we can answer a couple questions. Let me just pull up the list here. Well, I think first off, Lisa, you talked about earlier that, where an investor makes $1,000 investment in Ontario, effectively after accounting for all of the tax incentives or after tax costs, $310. When they sell the shares, is the $310 their cost base or is it zero?
No, the cost base is actually deemed to be zero. So that would mean, obviously it depends on the sale price, but the full amount of the proceeds of sale is a capital gain. And then, of course, half of that is a taxable capital gain. And one thing, again, I probably sound like a broken record on this, but because of alternative minimum tax, some of the impacts given the sort of phantom gain, if you will, that's associated with flow-through shares can really exacerbate that situation. So, you do have to be aware of the fact that it is the full proceeds of sale that is treated as a capital gain.
Excellent, thank you. Just looking here. For CDE, and Stephanie, perhaps you can help us with on, is there a list of clear expenses that are eligible to facilitate the classification of expenses in the budget? And I guess perhaps this is in the context of bringing a mine into production.
So for CDE, the types of expenses that are generally included would be costs related to clearing, removing overburden, stripping, sinking a mine shaft, or constructing an adit or other underground entryway. The costs have to be incurred before the mine reaches a commercial level of production, and it's not an exhaustive list. It's again a purpose test. So the costs have to be incurred for the purpose of bringing a new mine in Canada into production.
Very good. And Lisa, we have a question here on Quebec. So Quebec obviously did some changes, to their individual flow-through share tax deduction. Just curious how you've seen that impact Quebec flow-through share issuances.
Yeah, it's actually been fairly significant. There were some additional, they weren't really credits. There were sort of enhanced deductions that were available to Quebec flow-through share subscribers, which were eliminated. But at the same time, there were some corporate credits that the company doing the exploration could take advantage of that have been increased. But what's tricky and what we've seen arise as a result of that is that when a company decides to do exploration in Quebec and issue flow-through shares, they basically have to make a choice. I mean, they can either collect the corporate credits or they can issue flow-through shares to Quebec residents. So many people are choosing, because the corporate credits are so attractive, to issue flow-through shares outside of Quebec, which allows them to collect those corporate credits, since no Quebec taxpayers are getting the advantages of flow-through shares. The problem with that, or at least the thing that has to be recognized with that, is that the amount of the corporate tax credit received by the issuer of the flow-through shares is considered assistance under the Federal Income Tax Act, and that amount reduces the CEE pool. So additional hard dollars are required to be spent on eligible exploration expenses in order for the issuer to be entitled to renounce the full amount that they have an obligation to renounce, which is the amount that they raised using flow-through shares. So it has made things a little bit more complicated, and certainly is something that anybody who is issuing flow-through shares to fund a Quebec project should be aware of, because there's a few different ways of going about it.
That is quite interesting. So effectively, an issuer could renounce to non-Quebec subscribers, but then retain the Quebec refundable credits for themselves. But there's a circular issue because of the government assistance.
Yeah, and depending on who you talk to, that circular issue could be even greater than you might expect, because if you have to spend, let's say, an additional 45%, which would be the amount of the critical minerals corporate credit in Quebec. And so let's say instead of $1 million, in order to renounce $1 million, you'd have to spend 1.45 million. But since you've spent 1.45 million in exploration in Quebec, you're entitled to a credit on the full 1.45 million, not just the 1 million. So is there sort of this like spillover effect, which means that, the amount of additional hard dollars you need is quite considerable.
Understood.
Thanks very much to the panel. We've got the last few minutes, and we do have the Q&A function. I see a number of questions still coming in, and I'll maybe just try and get a few of those bullets. With respect to this presentation and the webinar general, yes, it will be posted. It'll be available after today. So keep your eyes open on your inbox, as we will share out notice of that. a few other quick questions here. Do flow-through share projects need to be signed off by a professional geologist or a qualified person? Question to the panel. I think the simple answer is yes. There is a form requirement that does require a qualified person's signature, but please add on to that.
Well, I think in terms of the flow-through share documentation, Stephanie talked about for a CMETC issuance, there needs to be the certification prior to the agreement being entered into. For a non-CMETC exploration program, in theory, you don't need any documentation filed with government. But obviously, as you mentioned, Jeff, it's important that you have a qualified person involved in your exploration plan.
There's one other thing to note about that, which only comes up occasionally, but the qualifying person who signs off on the critical minerals certificate has to be recognized under the provincial regulator, because geologists and engineers are regulated provincially. So if your project is in Ontario, you've got to be a member of the regulating body for Ontario. And so I have seen issues arise where someone's qualified in BC and they're signing off on an Ontario project, and that doesn't quite meet the technical requirements.
Thank you. Appreciate that detail. A couple other quick ones. With respect to community consultations, I think we did cover that, and I will note the mining expenditure review table that was shown on screen today. It's also available on the PDAC website, so all of those line items that are eligible are listed there. There is also a technical interpretation that PDAC solicited a few years ago with respect to community consultations and costs related to that. It does suggest that there is an expanded eligibility for issuers to be able to do things like baseline work that may be outside of the specific parameter of obtaining a permit. There was a question here about at the first stages of exploration, even before there's on the ground, there is requirements for consultation to occur. Those should be eligible as far as I understand. Is that correct, Michael, Stephanie, Lisa?
That's right. I mean, I think the tax law was amended to recognize that, these costs are an important part of the exploration process. And the CRA, and the technical interpretation, which I think also is on the PDAC's website, does acknowledge the duty and requirement to consent and consult. And so, I think we would suggest that issuers refer to the CRA guidance as to what types of costs they would, accept, and even going to things like capacity payments to the extent that they're required in the course of, consulting prior to an exploration program, could potentially qualify as well.
Thank you. One last one, and then we'll have to end off. I do see a few questions that kind of relate to consulting fees or lease of equipment or materials or intercompany. And I know that flow-through can't be used towards things like G&A or salaries, but is there some nuance in there with respect to, leasing equipment internally or sort of the approach of being an internal consultant versus a staff? Is there nuance there that should be appreciated?
Well, I think I'm happy to take this. There's this concept of CEDO, Canadian Exploration Development Overhead Expenditures. We did talk about that earlier, in terms of salaries and wages and, rental costs. So I think the way to look at it is that you can meet the purpose test in CEE, but CEDO actually carves out amounts that you don't qualify for flow-through share treatment. So we'd suggest that you refer back, their CRA guidance as to, what would meet the requirements versus not on that before, including things like salaries, wages, and consultant fees for individuals that, are not substantially all dedicated towards exploration.
That's a great answer. And a number of great answers. A ton of useful information, probably more than a lot of people can absorb in an hour. So thank you very much for being able to get that out to the world. As a reminder, this will be available afterwards. So take note of that. A big thanks to you, Lisa, Stephanie, and Michael, for taking your time, all the efforts you put into this webinar today. We really appreciate it. I know the members will value it. So thank you from PDAC to you. Thank you, everyone, for joining. And thank you for being PDAC members. We look forward to seeing you next March 7, 2027.